Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, will provide you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Thanks for tuning in to our Real Estate 360 program today, your number one source for all of your real estate needs and education. We are broadcasting from the number one business radio station in San Francisco Bay Area, KDOW-AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360 that comes to you daily Monday through Friday at 3 p.m., along with my co-host, Joe Kuchera and Laurie Graymont. So please tune in each day for different guests and different program content. Every day of the week, we have a new program for you. If you can't make the live show, you can catch our podcast on RE360radio.com. And you can catch my programs on TomWilsonProperties.com or on iTunes. And if you have questions or suggestions for topics that you'd like to hear, please let us know on TomWilsonProperties.com what those questions are or what things you'd like to hear more about. Also, if you go to that website, you can also request a weekly newsletter on the economics that are going on in the nation from the past week and how they influence and affect real estate. So that's a nice 1-minute read to help you summarize what's going on in the world of economics and real estate. Also, there are various reports and so forth that we'll mention later. So please write down that website number, and anytime you have a question about real estate, please let us know. You can also go to RE360, and that's a site that includes all of the program content for the week and our and all the information from our other co-host. We have a good program today for the real estate investor. We have with us Joe Hernandez, who's the manager of acquisitions and sales for Wilson Investment Properties, and he's been doing that for 7 years. And has talked to many, many investors and has acquired many properties and has a lot of experience in that area. And Joe, it's nice to have you with us today.
Thank you very much, Tom. Nice to be here.
Joe's in the studio with us, and we're going to walk through some questions and look for what experience and takeaways that Joe can share with us from what he's learned with working with these investors over all of these years. First of all, Joe, what do you think this is a good time for investors to buy properties for long-term hold?
I do. I think that the appreciating market and the types of returns you can get on these homes, it makes it a good time. So, and
it's probably a window of opportunity that may not be repeated in our lifetimes.
No.
Over the long haul, we've had a correction here in prices. And varies that has varied tremendously from city to city, but all areas have come down, and most cities are recovering. We could discuss whether or not that's a bubble, but I think the long-term trend is going to be upward, and I think that's a good thing to invest in toward your retirement. It's amazing when you see the stats on how many people are dependent upon Social Security to be able to retire. Mm-hmm. And I think you talk to clients every day who are buying real estate investments for their future. What are they telling you that they're looking for?
Well, they're primarily looking for cash flow. They're looking to buy properties that will support them after they retire. Most investors feel that if they get 10 cash flowing properties, that they will be able to be self-supportive for the rest of their lives. And I think that's kind of the goal. A lot of people that we run into are nearing the end of their career and see that Social Security may not actually be there for them, and they want to start taking advantage. They want to get some properties in their portfolio and build a retirement fund for themselves.
In effect, and most of them are interested in buying houses, aren't they?
Yes.
We occasionally get somebody that says, "Gee, I'd like to go buy a multifam."
Yeah, but with multifam, it's tough to get financing for multifams.
Almost impossible.
Yeah, unless you're an experienced investor, and most of the people that we run into are career path people, and they're not that involved in real estate. They want something easy. They want something that they can understand. So, and multifam, it doesn't make sense unless you have a big scale.
From my experience of buying 7 different multifams over the years, what I've learned is that on the surface, you would think that a multifam is the same as houses. They're just all put together. But what I've learned is there are a lot more variables that affect that property and its potential for return. So some I've had did very well, and others I've had did poorly, much poorer than houses. And I think that's more of a risk than what most people want to take on, especially if they're trying to be predominantly a passive investor. Mm-hmm. There's just many different variables in a multifam, like the manager that's on site, the maintenance people. You have all these people put together in one place, and if you get one person in there that's bad, the others can go disappear quickly because they don't want to be around that bad person. You got landscaping and some often master metered water and things like that. It's just and you got more regulations from the local city and authorities and the lender and so forth. So it's a lot more complex than it appears on the surface, and it's academic for most people. Most folks are primarily involved in their career, as you say, and they are looking for, a retirement portfolio. I think you put the nail on the head there. Houses are simple, and everybody understands it.
Yeah, and if it ever comes a time where you need to sell these properties, it's a lot easier to sell a single-family home. You have a much bigger market to sell to. It's going to appreciate more than a multifam will, because multifams, their values are based primarily on their cap rates and the kind of income that they produce. So,
whereas houses prices are driven primarily by owner-occupant demand, right?
Yeah, people who want to live there.
Mm-hmm, more emotional and jobs related,
and you could sell one of 10, not the entire nest egg there. So, they make a lot of sense.
And you can spread out that risk over a large area by not having them all on the same address, right?
Yeah, and different areas appreciate in different rates, so you can lessen your risk.
Certainly, at one time in the Bay Area, rental properties made some sense. I remember when I bought my first property in 1970, it rented for $30,000 and it rented for $300,000.
Yeah,
and there was a 1% rent ratio, which we'll discuss in a moment. But it's been a long, long time since we were in that boat. Even after this historic drop in prices, it's still been very hard to make something cash flow with a decent quality product in the Bay Area, isn't it, Joe?
Yeah, if you're investing here, you're hoping for appreciation. And a lot of people got in a lot of trouble by hoping for appreciation in the last cycle. So if you're an investor, you need to invest for cash flow. And any appreciation that comes on top of that is a bonus. It's gravy.
Yeah, that's great. That's great advice. The days of speculative investing should be over. We see people starting to do that again now.
Yeah, it's hard to not want to try to do it right now.
No. Everybody wants a quick buck.
Yeah.
But I've always said I think, real estate is the best get-rich-slow scheme there is.
It is. It is.
What do you tell people who are a little nervous about buying their first products out of state? Now that we've seen that it's pretty tough to have a good product and cash flow here in California, even after this drop. Someone's nervous about going out of state. What do you tell them? Why should they consider that?
I've heard you tell people this a number of times, and it's always resonated with me, is when you're looking at stock, going to the company and looking at how it's built and meeting all the people there. You're looking at the type of return that you're trying to get. So I would approach it the same way. Try to find a market that has solid fundamentals. It has a solid economy. You want people that are going to want to move to that area. So you want strong employment. You want a decent cost of living, and look for cash flow.
And let's talk about some of the other factors they're looking for too. Certainly, jobs is an important.
Jobs is huge.
Critical factor. You want a place that's going to have population growing so that you have an increased demand, which drives prices up of your product.
Mm-hmm. Especially with these times where construction is not really happening, and for them to ramp up and start building more houses, it's going to take a little while. So you're going to have more appreciation.
People are excited about having a little bit of increase in permitting and starts, but that's relative to zero starts in the past 3 or 4 years. So it's still not even in the ballpark of where it was at its peak. So right now, it's just new construction is very difficult for anyone to justify. But we do have some cities that are growing in population because there are jobs going up, and that's most cities are still struggling a bit, especially a lot of California cities, except for the Bay Area.
Mm-hmm.
And one of those places that we like in our business is Dallas-Fort Worth. Mm-hmm. It dropped the least of any metro in the United States compared to per Case Shiller.
And its median home in that area has gone up 8% in the first quarter of this year. So that shows you the kind of, even there's a strong demand for housing.
It's amazing how many people think that, well, if I go out of state, I guess I'll get cash flow, but I hate to give up appreciation. I sure wish I could get some appreciation. Well, they don't realize that, it's certainly there's some of these other metros like DFW, there's still reasonable appreciation, which is some pretty good gravy on top of that cash flow.
Mm-hmm.
But cash flow people should invest in cash flow now. Investing in something that they hope will cash flow someday is certainly, I think, a pretty bad philosophy and by today's standards. When we come back, we're going to talk a little bit more about how to select a property, about property management, other factors that go along with real estate investing for your long-term portfolio. This is Tom Wilson with KDOW, 1220 AM, Wall Street Business Network. And we have Joe Hernandez with us today, who has 7 years experience with Wilson Investment Properties as Manager of Acquisitions and Sales. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. For more information on today's program, visit RE360radio.com. That's RE360radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. Today we have Joe Hernandez, the Acquisitions and Sales Manager for Wilson Investment Properties the last 7 years, who's talked and helped and serviced many, many clients. And we were discussing out-of-state buying. And Joe, let's talk a little bit about the leverage factor. Many people say, my gosh, I like the cash flow idea, but I hate to have no appreciation.
Mm-hmm.
Talk to that a little bit, if you will.
Well, I think that they need to pay attention to, if you're going to go to Dallas, let's say, and you put 20% down, and the market's going to appreciate 3 to 4% an average a year, then what you're basically getting all that appreciation. The appreciation on top is just added to your 20%, so you have 1/5 of that investment, and you're getting all the appreciation.
And in fact, until the crash, the last 2 decades, the DFW, for example, was appreciating 5 to 6% a year.
Uh-huh.
Now, we don't know right now. We just had a 8% bump, you
8%
said, in the last
quarter.
So this crazy market that we're in throughout the country is hard to predict. That's why we recommend investing for cash flow right now. If there's any one takeaway that I've had from my time over the years with Robert Kiyosaki, invest in assets that will cash flow now. Mm-hmm. Interesting that even though there are those that profess that it's good to have a little gold to hedge against dollar value that's likely to go down, that's one of the negatives about gold. It does not have any cash flow.
Mm-hmm. It's like raw land.
Yep. So indeed, if you a leveraged asset like a place in DFW is going to give you more return on your dollars down payment than it will in some other market where you have to put more down to get cash flow, doesn't it?
And hope for higher appreciation, which may not be the fact.
Yep. Or it may be a brief sprint, and then who knows? There are those who certainly are concerned that we're building up another bubble.
There's a lot of markets that are appreciating and do not have the fundamentals to support the appreciation, such as Phoenix. Phoenix has recovered substantially, and we've always professed that you want to have inward migration, because inward migration happens because there are jobs being created, and that's going to create demand for housing, and that's going to create real appreciation. And I don't know if that's actually... There are some markets where that may not be happening.
Yeah, I think when some places people are excited and there's growth in the housing prices, and if they can't tell you or you can't put your finger on why, that's a concern, isn't it? Mm-hmm. It's got to have a good fundamental why, like, gee, there's 25 corporate Fortune 500 corporations there that are adding jobs.
Yeah, and there's another factor that's in today's market that really hasn't been in play up until now, and it's all these hedge funds that are buying up houses and creating artificial appreciation in this market.
Yeah, that's good. Let's expand on that a little bit. So tell, for those that aren't aware, talk to them about the whole hedge fund business.
Well, the hedge funds are buying up properties in hopes that they're going to create REITs and have this rental portfolio that they're going to hold on for however long. And once the markets have recovered, they're going to sell them off and make a nice profit.
So for those that aren't familiar with it, there's a number, probably 5 or 6 large hedge funds who've decided to get into the real estate business, and they are driven by Wall Street backed funds largely, and they haven't been involved in real estate per se. You certainly don't have to have direct experience in something in order to do well, but it certainly helps. Now they've decided that as long as they can sell it to a greater fool for more than what they're buying it for, they'll pay anything for it, right?
Yeah.
And they've been overpaying.
And that's the problem that we've been running into, is they've been overpaying for properties, paying market or above market for properties, and buying everything. So. Yep.
So for those of us that know that it's not a good value, we just refuse to participate in that market. And who knows where this is going to go. So we were doing 40 offers to win one. Now we can't even find 40 to put offers on. But we'll get back to that in a minute. This is Real Estate 360. We've got Joe Hernandez with us, who's talking about investment properties and what we should know about it before you jump in.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. For more information on today's program, visit RE360radio.com. That's RE360radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. We have Joe Hernandez with us today, who's the manager of acquisitions and sales for Wilson Investment Properties for many years, and he's helping us journey through the road of a real estate investor, what things they should know, what the takeaways are, how they can maximize the value of their path. So, Joe, why? Let's move over to what's the advantage of an investor buying from a turnkey provider? I mean, anybody can buy a piece of real estate. So, what value benefit do they get, and why is that important?
Well, if you've come to the conclusion that you do want to find the best place to invest, and it happens to be out of state, you're in a tough spot because you don't know anything about the community that you're going to go into. You don't know the right neighborhoods. You don't know the right people to work with. So it really minimizes your risk. You're following the path of a successful investor that's already been doing it in that market, who's developed the relationships with the right people, who has identified the right neighborhoods to invest in. With a turnkey provider, they are doing the rehab for you. So a lot of the time you will find that you think the rehab is one thing, and it turns out that you have to replace the roof, or you have some foundation damage, or some other stuff that just kills your rehab budget.
Surprises almost always happen, don't they?
Yeah. So the turnkey provider takes a lot of the risk out of it for you. They are making the odds that it's going to be a successful investment far higher for you than it'll be if you go try to do it on your own.
One, they're very experienced in doing it, and two, a good turnkey provider cares about their reputation and their follow-on business, and they try very hard to do a good job. We certainly do.
Yeah, most of our clients are people that work in this valley, and again, they're starting to think about retirement, and they buy probably 2 a year. So they'll buy 2. They'll see how it works out for 6 months, and then they'll buy 2 for every year after that until they get up to that 10 number. So that's really the type of clientele that we like working with, and that is we really work on getting properties that are going to create or help create those kind of clients.
What are some of the important team members of a good turnkey provider like Wilson Investment Properties that they bring to the party? What kind of people? Somebody might think, well, what are the kinds of folks that I need to know about?
Number one is going to be property management. Property management is going to make or break your investment in anywhere where you can't drive to the property to deal with any big problems. The property manager is going to make or break it. You need to have a good lender, and we have a few good lenders there in Texas. There are different lending environments, and you need to. The lenders that we work with in Texas work almost exclusively with investors. They know how to set up the loan so that you're not going to have any problems.
And that's critical with any of the professionals, aren't they, that are involved? A lot of people think, oh, geez, I'll just get any agent to go get a property for me, and they'll say, oh, by the way, do you know about investment property? And they say yes because they sold a duplex once last year. And that's a far cry from someone that's doing it day in and day out, working exclusively with investors. It's quite a different business system than the retail market.
There are not many agents that work almost exclusively with investors. So
and you got the insurance people and the lenders, as you mentioned, and even title companies and people involved with the taxes and so forth.
A lot of pieces.
A lot of different pieces that team's put together. So we're talking with Joe Hernandez today, Manager of Acquisitions and Sales with Wilson Investment Properties, and learning what his takeaways have been being in this business for a number of years. We'll be back here and just after these couple of announcements with KDOW 1220 AM, your Wall Street Business Network. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. For more information on today's program, visit RE360radio.com. That's RE360radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. We have Joe Hernandez with us today, who's manager of acquisition and sales for Wilson Investment Properties, and talking about things that investors need to know in making their decisions of when and where and what kind of products to buy for their long-term retirement plan. Joe, what about these days? I hear that 3/4 of all of the properties for rental that are advertised on the internet are from just referral services, not from ones that are on the ground actually doing it. I was amazed when I saw those numbers. What are the things you should be careful about when you're buying from someone who's not actually doing it?
Well, you want to buy you want to buy directly, number one. But you need to be dealing with the person that actually knows about the property, who's actually dealing with the property. You need to pay attention to the year built, the condition, if it conforms to the neighborhood.
Mm-hmm.
Don't really want a lot of out-of-state buyers that I run across want newer properties because they don't want to deal with any. They want to hedge their bets against doing any maintenance or having any plumbing problems in the future. So
beware of the property that's built in the 50s and it looks pretty, but might have some bones that are going to be expensive to maintain.
Yeah, there's a lot of systems there. A lot of the houses in Texas are slab foundation. So if you have a plumbing problem, you really have a plumbing problem. The older properties may look like they get more cash flow, but when they're usually not in the nicest neighborhoods, the type of neighborhood you have is the type of tenant that you're going to attract.
One thing I've noticed is that in the West, usually neighborhoods are pretty homogeneous, and it's an even gradient going from one to the next, whereas most of the heartland of America and the South and the East, and Midwest, so forth, you can have a really nice property right across the street from something that's a real problem that's next door to something that's really high end. So it's all mixed. You got to have folks that have feet on the ground that understand those neighborhoods and know how to pick out the right neighborhood and the right ones.
Sure. And those older properties, they may look like they get higher rent ratio or cash flow, and when it comes down to it, and you have a tenant that moves in there and they're paying you a really good rent for 6 months, but they end up leaving, and you have to do a make ready, and that ends up costing you $3,000 or $4,000. That's going to take away a lot of that added cash flow. So, and you have problems dealing with those people the whole time. So,
the weak neighborhoods have higher turnover usually, and they have collections problems. It doesn't make any difference what the rent is stated to be. If your property manager doesn't actually collect it, it doesn't do you much good. So there's a term of financial occupancy versus physical occupancy, and we don't care so much about physical occupancy. We want to know how much money you can bring in through over the course of a year relative to what you could have brought in, and that's what really counts. And that's something that the team on the ground in that city and that neighborhood are the ones that can answer that. What other factors do you think people need to be careful about and be aware of when they're choosing a product? And then we'll talk about property management. What else do we need to be selective about with a product? You mentioned age.
Make sure that the cash flow isn't absurd. Most of our properties get $250 to $350 positive cash flow a month, and that's a pretty conservative way to look at it. If someone's telling you that you're going to get $500 or $600 cash flow a month, you better look twice at that deal.
If it sounds too good to be true, huh?
Yeah, probably is.
There's no way getting around that.
Yeah.
Indeed, that's just the way it is.
And again, property management, you need to be very comfortable with the team members that they're putting you with, and that property manager, if they're not doing a good job, if they're not collecting, if they're not staying on top of the tenants to make sure that they perform, it's going to be a rough road.
So one, you got to have the right metro and the right product, and if you have a good property manager, you can maximize that. But if you have a good product, a bad property manager can make that underperform. But also, if you don't have a good product and a good metro, the best property manager in the world can't squeeze but so much blood out of that turnip. So, just the way it is. Let's talk about some numbers. What are some typical numbers, for a typical product in DFW that our clients buy? What's a typical price?
I'd say most of the homes we sell are 110, 120,000. They rent for at least 1% of that price. So often you'll have a house that we sell for 120 that rents for $1,250, $1,295. And they are newer properties in nice neighborhoods with good schools. We're trying to look out for you as the investor. We're trying to find you a good tenant. We want some of the best tenants are families, and the families who want their kids to go to those schools, and they're going to want their kids to go to those schools for a number of years. So they'll most likely stick around.
The buyer should be very aware of what kind of product it is. It's amazing when you look at a number of websites, as we do, how much information is missing.
Yeah.
Photos you expect. It's really scary when there's no photo provided. But, often don't show what year it is, so that's a flag. It's probably because they don't want you to know what the year is.
Yeah.
The parcel map and the tax records and public records that allow you to verify the facts that they are showing you is very important. What the community looks like, what the demographics are, school, what are the actual income and expenses now, not what they hope they might be in the future, but what they are now. It's just all very, very critical elements, aren't they?
The more information a provider gives you before you purchase the property, the better off you're going to be.
And a typical product need 20-25% down. By the time you have closing costs and prepaid tax insurance, you're looking at about probably $35,000 for a typical property.
Yeah, I'd say 30, 35, something like that.
Okay. Well, we'll be back to wrap up here in just a moment or two. We have Joe Hernandez with us, who's the manager of acquisition and sales with Wilson Investment Properties. This is KDOW 1220 AM, the Wall Street Business Network.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. For more information on today's program, visit RE360radio.com. That's RE360radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to Real Estate 360, where we're discussing the things that investor needs to know before making a decision on whom to buy from and where to buy. We've got Joe Hernandez with us today, who's manager of acquisitions and sales with Wilson Investment Properties. So, Joe, to wrap up here a little bit, so what are the advantages of an investor buying from a high-quality, experienced turnkey provider like Wilson Investment Properties?
Well, in Wilson Investment Properties specifically, we are a California investor. Tom's a successful investor. He's already went to the Dallas-Fort Worth market, is heavily invested in it himself. So you are following a successful investor. It provides a faster path to owning high-quality investment properties. We reduce the time, the hassle, the risk of buying an investment property, especially in a new market. We are more selective on our products than if you just go on the MLS and try to find a deal. We have a very tight criteria on what we're looking to buy. Probably one of the biggest things is if you were to go buy something on your own, you have to close on it, you have to rehab it, you have to find a tenant. Who knows how long that's going to take. Most of our properties are leased by the time you close. You have a cash flowing property from day one. And we have all the resources that you need. We have spent a lot of time trying to find these qualified resources, and you can benefit from that.
Well, we certainly have a lot of compliments and feedback that that formula works well, and those kinds of features can certainly minimize the risk for our investors. And just be careful. I think you need some education, but you don't want to and research and due diligence, but you don't want to do it forever. You know, folks that have been paid tens of thousands of dollars for education and boot camps. They still don't own anything, so we don't want to do that either. So I think certainly one of my top tips for the day is to get an expert team, whether it's Wilson Investment Properties or any other team that you choose for the metro you want to go in, and you don't want to reinvent the wheel. Delegate. Go get folks that have had to help you out, that have had experience in that very subject and area and so forth. If I were going to, and even though I've bought and sold about 2,000 units over the years, if I went to another city, I think I have some good background to choose good people, but I still would want to make sure that I had some experts in that particular area. So thanks for being with us. TomWilsonProperties.com. You can go on that website and ask for a newsletter on economics for real estate, questions and that you have for us or subjects you'd like us to cover. If you have more questions for Joe, you can address them on that website as well. There's a report on how to select the best metro in the United States and how to pick the best products, and that's a 19-page report with lots of graphs that I think might be of interest to you. So thanks for being with us today. We've enjoyed having Joe on the program. Thank you, Joe, and hope to have you back sometime soon. And remember, the only thing that matters is what you do next.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.